Good morning and welcome to the Morning Fix. My name is Bhargav and today I thought we'd switch things up and talk about finances. Yes, it's all about Financial Friday, and joining me today in the studio is Miss Winnie Kimotho, who works as an assistant manager at PKF Taxation Services. She joins us on the Morning Fix to answer mine and your questions about the thing we all hear of but don't necessarily know of. Taxes. Winnie, welcome to the show.
Thank you so very much.
I have so many questions already for you playing in my head, but let's start off with the easy ones. What are the different types of taxes?
So I think I want to break it down for the listeners quite well today. And my first point is going to be that to substantiate the different kind of taxes, then we must understand the nature of those taxes. So the first type of tax is going to be income tax.
Right.
And under income tax, we have what we call employment taxation. Basically, it is what like I am employed by PKF Taxation Services. And of course, now my employer is obligated to deduct a certain amount of money from my pay.
Yes.
And remit it to the government. So
right.
I play my own share of contributing to the revenues and development for this country.
Right.
So I feel like the largest contribution by employees, of course, is going to be pay as you earn.
Yes.
And honestly speaking, it's a very small percentage of people who are employed in Kenya, but they contribute heavily to the revenue in this country.
Right.
And then, of course, we have what we call corporation tax. Corporation tax is paid by corporations. That's how we say corporate tax. So we're talking about 30% currently. Last year during COVID relief, we were talking about 25%.
Yep.
But right now we're talking about 30%. So it's ideally what you say, this is what I have sold during the year, my total sales. I less my expenses, my operational expenses, or even other financing expenses. Say, for example, you've taken a loan to finance your business. That's an allowable expense. The interest that you're going to pay is going to be an allowable expense.
Right.
Any other expense, like say, for example, my pay, the PKF in cash to keep me there, of course, it also becomes a deductible expense. Any other thing, including the furniture that they're going to buy, of course, there's a certain deduction for the wear and tear. Remember, this furniture, of course, the value does not remain to be the same in perpetuity. It decreases in value.
Yep.
So, of course, also the government allows you to take in or to take care of the wear and tear for such items. So, ideally, income tax is paid by corporates. And under the same ambit of income tax, we have what we call withholding tax. Withholding tax is basically paid by professionals like Winnie and anyone else who's providing professional services. So I'll give an example. Radio 44 contracts PKF taxation to provide professional services.
Yes.
At the point of Radio 44 paying PKF taxation services for the professional services that Winnie has rendered, then you're required to withhold 5% if you are a resident. If, like say, for example, I am a resident of Kenya.
Yes.
But if you were paying to PKF Liberia or somewhere else, then of course you'd be required to withhold 20%.
Okay.
However, I'd like to add something to that. The rate of withholding tax when you're paying to someone who is not resident in Kenya differs at some point, whereby we have a double taxation agreement. The government of Kenya has a double taxation agreement whereby we're saying the taxes are going to be graduated or reduced.
Right.
So that is basically withholding tax. And then, of course, we have turnover tax.
Yes.
Still covered under income taxes. We will come to that later.
We have to come to that.
And we have lastly transfer pricing. Transfer pricing is what we call cross-border taxation. We are determining if, say, for example, PKF is operating in Uganda, in Tanzania, in Kenya, then what is the fair share of revenue for Kenya, for Uganda, and for Tanzania? So that's basically what transfer pricing is all about, and ensuring that any dealings that PKF Kenya is going to have with PKF Uganda are at arm's length. Arm's length means it definitely means that the same way I would transact with Radio 44 because we have no relation is the same transaction I'll have with PKF Uganda.
You mentioned some of the taxes that are there, the income tax, the corporation tax, the payee, and all of those. Which other taxes are there that we need to touch up on?
So there's value-added tax.
Yes.
Value-added tax, of course, you're talking about consumption taxes. It's basically a consumption tax. So So when you go to the shop and you buy your sugar or you buy your rice or whatever it is, then of course you're going to be paying VAT. So ideally, for people who are not employed, then they'll ideally suffer value-added tax.
Yes.
And then of course we have what we call customs. Customs duty you pay it at the point of importation. So if you go and import this furniture, there are certain rates that are actually stated in the Customs and Excise Act.
Right.
It's basically uniform in the whole of East Africa. So when you import, you're supposed to pay certain duties on that importation. Especially if you've imported a car, then for sure you know what customs duty is. And then lastly, we have excess tax. Excess tax, we like to refer it as a sin tax.
As a sin tax?
Yes,
okay.
It's a tax on luxurious goods.
Right. So
basically you're being punished for you taking alcohol because it's not as basic. And you're also being taxed for smoking because cigarette is not as basic. Yeah. And of course now there's a new luxury, which is mineral water. You assume that you're very luxurious when you take...
When you drink mineral water.
Yes, because... I mean, a normal person will go to the tap and have that water anyway, but you're taking the sophisticated water. So excess tax is basically a sin tax. You're going to be taxed because of taking a luxurious good.
Oh, wow. Okay. Yeah. Now that I didn't know of.
And
I thought excise duty is just there, it's just...
and of course, even actually to take care of some things and to discourage the consumption of some of those things.
Yeah.
Say, for example, when you buy a car, the whatever it emits, it's actually very dangerous to the environment. So even at the point of importation of the car, you're also charged excess duty for that reason.
For the carbon emissions.
Yes.
Right, yeah, actually, that's very true. But you said something that is the elephant in the room.
Yeah.
The minimum tax and the turnover taxes. It is blowing everyone's mind because it started from 1st of January, right, if I'm not wrong.
Yes.
So what is the difference between minimum tax and turnover tax?
So there is really no major difference.
Okay.
It's just that it is who it is applied to.
Mm-hmm.
So when you look at minimum tax, what it is trying to say is that for every sale that you have, you're supposed to pay 1% on the gross turnover.
On the
so
gross
if you're
turnover.
selling books and you sell 1,000 books at 10 shillings, then of course that's 1,000 times 10, that is 10,000 shillings.
Yes.
Then your minimum tax is going to be 1% of that 10,000 shillings. That is what you should pay to the government.
Okay.
Please remember, do not deduct any expenses. Do not deduct whatever it is, just pay the minimum tax. So why did minimum tax come into play? Maybe that's the question.
Yeah.
It is because there's some people who have loss-making entities into perpetuity. You're just basically in a loss position.
Yes.
So the government brought in minimum tax so that it can actually take care of such loss-making entities, just to make sure that they pay their own fair share of taxes. But if you ask me, it's very punitive and it's very retrogressive in my opinion, and it still remains to be my opinion.
Yes.
Because we are in a country whereby we're still trying to attract investors to encourage that they come and invest their money here, to actually spur development, to spur employment rates, and that we cannot because we are really discouraging people. Let me just take some time and do something that I usually don't do, but I'll simulate it for you.
Okay.
Before, what used to happen is that you have invested hugely.
Yes.
Like $1 billion. You've bought machinery. So ideally what would happen is that you'd get a return on investment by claiming capital allowances at the prescribed rates.
Okay.
Now what minimum tax is saying, it has actually invalidated some sections of the Income Tax Act, whereby you cannot claim any expenses, you cannot claim any tax relief on those investments that you've made. And I can tell you, people are really investing a lot in this country.
Yes,
and we're discouraging them. So what are we doing as a country? We are chasing them out of this country so that they can go to where the cost of production is going to be low and their products are going to be affordable. And another thing that I'd like to tell you, people are wondering, why is there a certain increase in prices of basic commodities? It is because as a manufacturer, I need a return on investment. So the best thing I can do is to pass the cost to the consumer, because I also need the money and pay the government. Yeah, so minimum tax has its own effect. What's the difference with turnover? Turnover ideally and initially was meant to be for the informal sector. People who do not have incorporated businesses. But as of last year, incorporated businesses whose turnover is 1 million to 50 million now can actually enjoy turnover tax at the rate of 1%, reduced from 3% to 1%. So the difference is the turnover. Turnover tax is applicable for entities between 1 million to 50 million. Anyone above that, it is minimum tax. But also remember, it is optional. Turnover tax is optional. You elect to be under turnover tax. Turnover tax, however, is not applicable to anyone who has rental income, and it is not actually applicable to people who are doing management and professional services like PKF.
Now I have a question for you, the big one, right? I don't think I've understood it quite well yet. Don't think many people have also understood it quite well. Digital service tax. And KRA keeps printing. In fact, today also on the Daily Nation, I think there's a small strip for digital service tax being implied from 1st of January. What exactly is this?
I'll actually tell the audience it is what it is. It is digital service tax. So ideally, we're talking about a tax that is put on, or that is actually on, the digital services that have been provided.
Right.
So say, for example, you have a platform that you're supposed to be trading on. So essentially, for the person who is the owner of the platform, they will be providing a service. Let me just take an example, Uber.
Right.
Uber is a platform that enables you as a customer and the driver to actually interact on it. So Uber is providing a digital tax. So any revenues that they're actually earning should be subject to digital service tax. So the question is, how does digital service tax apply?
Yeah.
Someone who is actually subject to digital service tax is not subject to other taxes under the income tax. So you're not going to be subject to minimum tax, you're not going to be subject to turnover tax, you're actually exempted from the ambit of those taxes.
Okay.
So what happens is that person who's doing digital service tax, 1.5% of their gross revenues is what is being subjected to tax. So then arises the question, people like Netflix who are actually providing services on a digital platform, what is going to happen? So ideally, because Netflix are providing a service over the internet, of course also they should be subject to the digital service tax. Then the question is, the cost is going to be passed to who? I am yet to see, but I do not know, but I'm still waiting to see. But there's one thing I'd like to add, at least for the listener to know. Every other country is looking forward to taxing these entities that are actually deriving money from the Kenya, internet. Actually from the customers of Kenya, so that Kenya can actually gain its own fair share of revenue. It's a competition. If you look at Google Kenya or even Facebook actually derives a lot of revenue from advertisements in Kenya, of whose the audience is in Kenya. The activities are taking in Kenya. So under the Income Tax Act, then such revenues have actually been accrued or derived in Kenya. So then the question again comes,
why not
Kenya is going to demand the taxes from that service. But as well, where Facebook is incorporated, wherever it is, then of course that country as well is also going to be demanding their own taxes. So what you're going to see is that most corporations who are providing digital service taxes are actually going to suffer at some extent double taxation, but that's an issue of countries to agree on. But also it's fair that Kenya gets it revenue. You can't say that you're going to operate without paying taxes. Let everyone pay their taxes, that is fine. But also it remains to be a global quagmire.
Now, the big one, the big four agenda and the new tax laws. How are they going to be interacting with each other?
I think if I was Uhuru, I'd have resigned, and I'm sorry to say, but unfortunately I'm not Uhuru, because he's really having a tough time. Because imagine COVID. Imagine COVID. COVID came. He had to offer tax reliefs. So meaning the revenue collection actually went down. He needs to finance the operations of this country. But for him to spur development, he requires money. So what does he do? He comes back to the people. The people have the money. So he actually wants to put in place measures that can give him more revenue. That's how we're seeing the introduction of minimum tax. Then begs the question, if I take you back some time, we had something to encourage manufacturers. We were having electricity rebates. So whereby the total cost of your electricity, you'd claim it 100%, and over and above that, you also claim 50% of the same bill in your financial statement as an expense. Now, Uhuru came and reversed that because he thought, oh, okay, I'm losing a lot of money, because imagine 30% of now that 50 of the bill, 50% of the bill, I am losing a lot of money. So what he has done now, with a measure to get more revenues, now he has introduced minimum tax. Now imagine people who are in the manufacturing industry with such huge investments that they have made, some millions of money, some billions of money, they cannot claim capital allowances on such monies. Then what does it do? It gives a setback to the big four agenda, because most people are in the value addition processes in Kenya. They get the cabbage or they get the potatoes, they manufacture crisps or what they have you. So actually that's what we call value addition. Now someone has invested a lot of money to do the value addition, and they cannot claim capital allowances, and they have to pay 1% of the gross turnover.
that.
Tell me. So if I were him,
It's tough.
It's a hard place that
Yes.
he's using. It's actually what you say, he's in between a rock and a
Hard place. Yeah.
It's very tough. I actually would think he's having sleepless nights trying to think about it. If I were him, I'm just trying to imagine. And then of course you look at the population in Kenya. Most people are actually not employed.
Yeah.
So, and the informal sector is largely untaxed. So meaning it's a struggle. That's why he's actually digging deeper into people.
The formal sectors.
Yes, and also that's why we're trying to go into the digital market
Yeah.
for us to get more revenue. So I think the Big Four agenda has had such a huge hit, and it's a setback because of COVID-19 and lack of revenues in Kenya.